Iran is making a return to the global oil market and certain that the country's output will add to the oil global glut around the world. However, the new production is Iran's effort to win back the market share it lost during sanction years. Does that mean the market will be swamped with oil?
It's a critical juncture for global crude. Four big oil producers, Qatar, Saudi Arabia, Russia, and Venezuela, last week announced a deal to freeze production at January levels to stand the oversupply. But some analysts don't expect any fundamental impact from the output freeze deal. That's because Iran has rejected the deal and because OPEC and Russia together in January were already producing 1.5 million barrels per day, more than they were a year earlier. And now there's a question mark if other producers will stick to the freeze plan if Iran refuses to join in.
If Iran doesn't cut production or even freeze, it's unlikely, it's doubtful that Saudi Arabia or UAE or Russia would want to shoulder that production cuts because they would want also to maintain or increase their market share. So I think that at this point, even though there are a lot of discussions, the chances of a coordinated production cuts or a freeze, I think it's limited.
This developing deal was the first among the oil producers in 15 years. It reflects the deep concerns even within the oil exporting cartel. However, Iran says it will continue increasing its production until it gets its market share back to levels reached before international sanctions were imposed. Some analysts expect ICE Brent prices to hover around $30 to $31 per barrel in February and March. The oversupply is likely to continue in this year's first quarter, but will decline in the second quarter, with prices maybe rebounding in the third and fourth quarters to around $40 per barrel. But buckle up, oil market. Some experts say oil prices are still likely to plummet to $20, although they don't expect the low prices to sustain. Xia Cheng, CCTV.